Have you ever felt like you're living in two completely different worlds? Because that's what's happening with the global economy right now. On the one hand, you've got financial markets, stocks and assets that are just soaring to unbelievable heights. But on the other hand, the world for most people feels, well, fragile, uncertain, and kind of broken. So how on earth can both of these things be true at the same time?
This quote from Antonio Gramsci just nails the feeling of this moment, doesn't it? It really feels like we're caught in this strange, unsettling in-between phase where the old rules of how economies are supposed to work just don't seem to fit anymore. And the new ones? Well, they haven't been figured out yet.
And here, right here, is the heart of the puzzle. This is where it gets really weird. We're seeing two totally opposite types of assets just skyrocketing. You've got AI stocks, right? That's a risk-on bet. It's a bet on the future, on growth, on innovation. But at the same time, you have gold, the classic risk-off asset, the place you run to when you're worried about everything falling apart. So why are both of them doing so incredibly well at the exact same time? It makes no sense. It's a huge contradiction.
Yeah, that's the big question, isn't it? What is really going on? In this explainer, we're going to peel back the layers of this thing and try to figure out the hidden mechanics that are driving this bizarre tale of two economies.
Okay, so let's start with the official story, the surface-level explanation that everyone was running with for a while.
After a period of really aggressive tightening, cranking up interest rates to slam the brakes on the economy, the big central banks did a complete 180. They turned on the money taps and started pumping liquidity back into the system. And in theory, all that cash should have kick-started a huge economic boom. More investment, more jobs, more growth for everybody. But that's not what happened. And this is the absolute key. That giant wave of money, it just never really made it to Main Street. The big recovery everyone was expecting in the real economy, well, it just kind of fizzled out. And this right here shows that disconnect perfectly. I mean, look at this. Even with all that money being pumped in, what was happening to jobs? Unemployment rates across most of the world's biggest economies were actually going up through 2025. This is our first huge clue that something is seriously wrong under the hood.
So if that official story isn't the whole picture, then we need to dig a lot deeper. It's time to uncover the major structural cracks that are hiding in plain sight in the world's two biggest economies.
That famous line from Charles Dickens has never felt more appropriate. Because what we're seeing isn't one single recovery, it's a completely divided, what they call a K-shaped recovery, where the fortunes of people at the top and the bottom are literally heading in opposite directions. And here's the first crack, laid bare in the US data. For the first time in a decade, wage gains for the top half of earners are growing faster than for the bottom half. So the rich are getting richer, while folks with lower incomes are getting slammed by inflation that just won't go away. This isn't a recovery, it's a split. The economy is literally being pulled in two.
Now, for the second crack, let's shift gears and look at China. And to really get what's happening there, we need to talk about a really important idea, the zombie company. Basically, these are companies that should be out of business. They're unproductive, they're drowning in debt, but they're being kept on artificial life support by the government with cheap loans and stimulus. And this isn't a small problem. It is a massive problem. Just look at this chart. The percentage of these zombie companies in China has been climbing and climbing, hitting almost 35%. This creates this huge glut of stuff they can't sell at home, which forces China to export its problem, exporting disinflation by just flooding the world with super cheap goods. It undercuts manufacturers everywhere else, and it's a really scary echo of what happened during Japan's infamous lost decade. Okay, so we've seen the cracks in the foundation. Now we can finally start to connect the dots and solve the mystery we started with. Where in the world did all that money from the central banks actually end up?
It's actually pretty simple when you think about it. Capital, money, is always going to flow to where it can get the best return. So if you're a big investor, why would you put your money into the real economy with its weak demand and rising unemployment? It just looks way too risky. So that whole wave of liquidity just bypassed it. It went looking for a much easier, more profitable place to go.
And here's where it went. This is the Buffett indicator. It's a simple ratio that compares the total value of the stock market to the size of the actual economy, the GDP. And in the US, it has shot past 200%. That's a historic high. All that money bypassed Main Street and flowed directly into Wall Street, creating this enormous, ever-widening gap between paper wealth and actual real-world production.
Now, you might be thinking, okay, but what about new things like crypto? Isn't that supposed to be a hedge against all this? Well, some research from London University looked into this, and it's complicated. Sure, crypto can offer insane returns, but it's also incredibly volatile. And actually, during periods of high inflation, old-fashioned gold has usually done a better job. The verdict on crypto as a reliable safe haven, the jury is still very much out.
So all of this brings us to our final section, the verdict. Because a system that is this disconnected, this out of balance, it just can't go on forever.
This line from the poet Yeats just feels so incredibly true right now, when the financial world becomes so completely detached from the real one. The very center that's supposed to hold the whole system together, well, it gets unstable.
I think this is the absolute perfect way to picture our situation. Think of the global economy like a game of Jenga. The soaring financial markets are the top layers, getting built higher and higher and higher. But the base, the real economy of jobs and wages and factories, is having blocks pulled out from underneath it, one by one. And you know what happens in Jenga when the base gets too weak? The whole thing becomes dangerously wobbly. And you know, history gives us a very clear warning here. This chart shows something called the CAPE ratio. Don't worry about the name, it's just a way of measuring if the stock market is overvalued. And what it tells us is crystal clear. Every single time in history that stock market valuations have gotten this stretched, this high, it has always been followed by a long period of much, much lower returns. A correction is inevitable.
So, the verdict is in. This great divide between Wall Street and Main Street just isn't sustainable. Something has to give. A rebalancing is coming. The only question left, the trillion-dollar question really, is what does that rebalancing look like? Is it a sudden, painful crash, or is it a long, slow, grinding stagnation like Japan's lost decade? That is the question that's going to define the next few years.